If you have a cash value life insurance policy and you are earning 6 to 7% in it, which would be great, would it make sense to borrow that money because you can obtain a loan from that policy at 4%, maybe 5%, and then take that loan and further fund the policy? Basically, you're leveraging a positive spread to hyper-fund the policy. Does it make sense? Because this has been around for such a long time with whole life and universal life. Many individuals pitch it in a different manner. The question is, does it work? Does it work from an illustration perspective? Many times it does, but does it work in reality? That's the main question. So let's get into it here. We're going to look at a lot of examples. We're really going to dig into the numbers, but first let's set the stage. What this positive spread often means is if I have a policy that's earning a dividend, say of 6%, this is a whole life insurance policy, and I have a loan rate of 5%, well, I've got a positive 1% spread on paper. So it should make all the sense in the world to borrow, correct? Well, remember, anytime we see a dividend rate, is that what I'm actually earning on a policy? No. That is a gross rate credited after the company's insurance expenses and mortality charges. I want that net internal rate of return. What am I actually earning? And then measure that against that loan interest to see if it truly makes sense. With an IUL, it'll be the earnings rate exceeding the loan interest. So if the earning rate exceeds the loan interest, that illustration will look fantastic because with an IUL, you can model this. You can take an indexed universal life insurance policy that has an internal rate of return of 5%, sometimes over 6%. And if you leverage it, boy, oh boy, can you make that thing look good. Illustrations look fantastic. But again, illustrations are not reality. That is what we want to look at here. We talk about this so often. How many times have I mentioned the big four or the four major mutual companies with a properly designed whole life insurance policy? I don't know, 10 million times. The reason why is when we look at actual data, companies that have actually lived the test of time and policies that have lived the test of time, we've seen four companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, consistently provide proof of concept, proof of performance. We see real policies, not just illustrations. You'll see where I'm going with this. So the main thing is illustrations are not reality. Dividend history, when looking at a whole life insurance policy, is not what we want to look at. If I am looking or considering another insurance company, the question I will ask them is, do you have any historical proof, real policies that have lived the test of time? Not just the dividend history, because there are other elements in a life insurance policy that will impact performance. I've got mortality charges, insurance expenses. The dividend is just one component. So a lot of times we hear, hey, look at our dividend history. That's great, thank you very much, but we need actual performance. With IULs, we hear this all the time. Market history. If you look at the S&P 500 over so many years, you have an average of 7 to 8%. Plug that into an IUL, and this is hypothetically what you should earn. Hypothetically, yes. Reality, that's the question. We've seen no. So with the S&P 500 history, an IUL should, this is the key word, should average somewhere between 6 to 8%. In fact, let's take a look at this. So here we see an IUL history here, 25-year historical look back, going from 2000 up until 2020. Nice clean 20-year period. We see what the S&P annual return was, and then we see what the participation rate was. What this averages out to is about a 6.4% of what the policyholder would actually earn. Where that comes from, that 6.4%, is right here. Average 6.4%. So what that's taking is the 20-year average here of the S&P 500. Down years with an indexed universal life, I earn nothing. I have a 0% floor. We're going to touch on this a bit more very shortly. Up years, I participate with the market, except for I have a cap of whatever the company's current cap rate is based on that illustration, 10.5% in this particular example. All right, so often what we see here is fund a policy illustrate the best case scenario. Call it that 6.4% assumption here based off of a standard illustration. And then loan from the policy with an IUL, very easy to obtain a policy with a loan interest rate of 4%. And then use the loan to fund the policy further. Because if I'm earning, let's call it 7% in an IUL, and I can borrow my own money at 4%, well, shouldn't I just take that and throw it right back into the policy? Again, this has been going on for a long time with whole life products. When the interest rate environment was more favorable, you would see it promoted a bit more. We never saw it work. And we'll get into more as far as to why it did not work. But on paper, is that attractive? If I can leverage my own money to create more money, heck yeah, sign me up, man. I'll do that all day long. But the thing is, why don't we do it? Well, here's some information here. When we take an indexed universal life insurance policy, a couple things. It is true 100% that we have the potential, this is the key word, potential to do extremely well. An IUL gives policyholders a ton of potential because instead of just receiving a guarantee and then a company's surplus, a whole life product with a basic dividend rate, we are tied to the S&P 500 in many cases. So we'll often have a cap rate, call it between 10 and 11%. The example we're going to look at here shortly is 10.5%. A 0% floor. What that means is that your cash value, your money is protected from any market downside. If the market goes down, you will not participate in those losses. So, for example, if we've got the S&P 500 here, my great graph, yeah, right, how the indexing will work is as follows. I participate with the gain, market goes down, I flatline. So let's do it this way. That is how an index will work. Market goes up, I participate with it, market comes down, my principal is protected. So that's the upside there. And again, I should average somewhere between 6 to 7%. Here is what we have seen in reality. Even if a policy is designed right, max fund, option B, right, minimum death benefit up to the MEC limit, do everything properly. From a design standpoint, you can mimic what you can do with a whole life insurance product as far as optimizing the cash value right off the bat. Cap rates. Here's the big thing. These, once a policy is in force after a number of years, we have seen these tend to come down. We've got several examples. The one that always jumps out is a policy that was issued in 2008. We were in a study period from 2008 up until the beginning of 2020, January 08 to January 2020. The cap rate at issue was 15%. The illustrated IRR was close to 9% when you looked at it over time. 12 years, actually he's in his 13th year, he's netted, this is actual performance, designed minimum commission, maximum cash value, 2% IRR, healthy, middle-aged, mid-40s, middle-aged male. The reason why it's underperforming and things are getting worse is that cap rate had come down. It is now 6%. Strong company, we've seen this, we have data on this with several different carriers. The issue with this is not the agent's fault, not the policyholder's fault. The insurance company has control of things. We do not. The cap rates are outside of our control. Cost of insurance here. This can increase and often does increase. What happened to this particular individual, while he is still positive, insurance expenses continue to increase at a rate faster than what was originally illustrated, and the cap rates came down, restricting his earnings. So kind of setting the stage here, not intending to beat IULs up, but when we go back to the positive spread, the theme of this video, an IUL is what is used with this strategy, because with whole life, can't really illustrate it today with where the interest rate environment is. It's not that attractive, let's put it that way. It's much safer, but at the same time, not that attractive. With an IUL, because of that potential there, you can make it look quite attractive at that. So let's take a look at an example here. First, we designed an IUL policy for maximum cash value. So first and foremost, we've got the guarantees, but let's look at the non-guarantees here. because this is often what is used in these assumptions. All right, here we go. So we have a 35-year-old male here, preferred non-tobacco, IUL carrier, and here we go. We see the non-guaranteed illustrative interest rate is 6.4% based off of the S&P 500 market history 25-year look back. So a couple things we have here. Non-guaranteed is going to illustrate that on the far right. Accumulation value, and then end of year surrender value. So the surrender value is what you would get as a policyholder if you cashed out the policy or 1035 exchanged it, for example. That's the surrender value. That in a sense locks policyholders into the product for a period of time. The accumulation value shows what the value looks like over time, assuming no surrenders existed, what we're actually earning based off of our earning rate. And there you go. A lot like a well-designed whole life product, you'll see, breaking even between years 3 and 4. So if it's properly designed, we can see strong cash values there. Okay, so you can do your thing with the design. That's great. Now, as time passes, we funded this for 20 years. Cash value, $365,000 at a 6.4% rate. Illustrative rate. We're going to look at the net internal rate of return as well, since we like to do that. Then we've got the alternate assumption, $247,000. We've paid in $200, we've got $247. What that is based off of is the alternate scale, a more conservative interest rate of 3% in this example. Okay, so the question is this, going back to the positive spread. If I've got money in this policy of X amount of dollars, I'm paying in $10K a year, so my cash value, if I borrow from it at 4%, should I take that money and fund it back into the life insurance policy? Doesn't make sense. Well, from an illustrative perspective, oh yes it does. You can make this thing look good. But from an actual performance standpoint, that's the thing. We have never seen it perform, and the reality is, if it doesn't perform, the lower that assumption goes, if in reality it produces 4 to 5% or below that, that's where a policyholder really gets into trouble. Let's look at some numbers here to actually demonstrate this. So what we did here, this will be a little confusing, but what we did was take the exact same policy and do as follows. So this is $10,000 per year out of pocket from the policyholder. He's paying $10K per year. Then what he does, beginning year 3, is loan out $10,000, both of these years, and pay it back into the policy. So he's borrowing $10,000 and then funding it with an additional $10K. So he's paying 10 out of K, 10K out of pocket, plus the $10,000 he loaned. That's why you see the annualized premium outlay here of $20,000. And he continues to repeat that pattern, increasing it by another $10,000 each year, all the way up through year 20, every other year. Now, if you are experienced, if you understand life insurance, or if you're an agent watching this video, the first question you would have here is, okay, how does that not mech, right? Because when I started the policy at a $366,000 death benefit, I was funding up to the MEC limit. So how on earth can I borrow money and then add it into the policy without triggering a MEC? Well, if we look at the death benefit in the far right, what do you notice here? Jumps up every 2 years. So some companies will allow you to do this. This is what is called a material change, where it is a face amount increase. Some companies will pay a new commission on this. Some companies will not, depends on the insurance carrier and such. However, it's a material change that pushes the death benefit up. What has a direct relationship to the MEC limit? Our age and death benefit. So through a material change here, you can execute this. And this is exactly what we see going on here. This is how one would be able to increase their out-of-pocket towards the policy. So, a lot going on here. We're going to break this down in Excel. One thing, there's your cash value year 20. In case you don't recall what the value was, this is higher because this is assuming a 6.4% assumption on cash value, but then at the same time, a 4% loan. Now, Let's lay them out side by side because going back and forth via illustrations can be a bit confusing. Okay, so we've got a 35-year-old male max funded policy. What we just saw, that max funded policy without any loans, this is what we're going to look at first. So on the left, you see the out-of-pocket payments, $10,000 per year for 20 years. Accumulation value, designed well, there we go, breaking even between years 3 and 4. Then we've got the cash surrender value, that's what we would actually get if we cashed out. Death benefit, 35-year-old male, that gives us the 10K MEC limit right off the bat, very close to that. Then we've got the annual internal rate of return. We based that off of the cash surrender value in this example. And then the average IRR. I always love to show these because we see these crediting assumptions from a whole life product, from an IUL product, whatever it might be, but it's not what I'm actually earning. What is my net return on cash value at the end of the day? The internal rate of return brings some light to that. So annual displays what you're earning that particular year. What did the S&P 500 do last year? 8%, that's what I earn on the policy, okay, or on my account. What did it do over the past 30 years? 7%, okay, that's my average. So as time passes, there we go. Annual IRR, quite strong here. Same thing with the average. This is where an IUL gives more potential than a whole life insurance product. Illustrates stronger values. It does because it can hypothetically produce stronger values. So we've got that. If we look at it over time, right, by age 75, what has it grown to? 1.8 million there. Okay, or 1.18 I should say. Looks good. Now let's compare it to the loan scenario. So I'm going to walk through this slowly and as thoroughly as possible because bringing transparency to this is important to do. Out of pocket for you, the policyholder, $10,000 per year. That's what I'm actually paying if you're this 35-year-old male. $10,000 per year. Annual loan to reinvest. So what the pitch we often see and hear in this case is borrow from your own policy because you're going to earn 6 to 7%, and because you can get your loan at 4%, you've got a 3% spread. Here's what it looks like on paper. There's my $10,000 loan. So my net payment over here is $20,000 the years that I still pay in 10K, but I loaned out 10,000. Here's my gauge determining how much I can borrow. So during the initial years, the early years when I take loans, this is well behind the example over here. This is always going to be pitched as a long-term plan. Again, positive spread, right? So if I've got a positive spread, it should work. On a paper, it will here. I do the same thing, starting to leverage larger loans. That payment, eventually get it up to $100,000, and we stop there after 20 years of funding because the material changes and calculating things took me a little bit of time, but I did enjoy it. So I've got my annual internal rate of return. Look at that, you see the difference here. The material change and bumping the face amount definitely had an impact on that as well. However, let's look at this over time. So 20 years down the road, what do we see? About 380,000 compared to what? 365,000. So I see a difference. Not a big difference while I am taking those loans each year and funding it, because we're taking heavy loans every single year and pumping more money into the policy, and the loan balance is compounding. The loan interest here is 4%. So this is going to compound over time. Now, as time continues on, and we pulled this directly from the illustration software as well, just the illustrations you saw there, imported it all on this. Let's look at age 70. 1.158 to about $890,000. Look at that. I'm starting to see a significant spread and significant improvement over here in this example. Basically, I'm getting something for nothing because I still have my initial 10K out of pocket, and I'm just banking on the growth of the policy, pulling it out and paying it in. Now, as you're watching this, I do not recommend this in any scenario whatsoever, just to be very clear here, and we're going to get into why. Not to be negative towards it. If it did work, we would do it. But again, we haven't seen it work over time. In reality, what happens here? We touched on this already. Look at the age, year 50 difference. Age 85, 3.1, almost 3.2 compared to about 2. You got a $1.1 million difference there approximately. Same $10,000 out of pocket. All you did was borrowed your own money and put it back into the policy and then executed that material change, which each time, if we have that material change and death benefit increase, that would require medical underwriting from the policyholder because I have the death benefit push up. So I would have to be healthy hypothetically to do this. But again, control is the big thing. This is 100% a what if. Insurance company controls everything, insurance expenses and cap rates. And where I get uncomfortable with this kind of stuff is cap rates on existing products, not new cap rate products, but existing products we see almost always come down at the end of the day with all companies, A-rated, and then those that are not A-rated. So what ends up happening is if cap rates do come down and the product does not produce between, call it 6 and 7% or greater, if I do 4 to 5% or less, that's where I get in trouble because that loan interest is not going to go down. That rate's not going to go below 4%. Not with the product that we have here at least, and once it's in force. So that's the kind of stuff I have to be aware of. In fact, let's illustrate this real quick because we've got that model up that we saw. All right, so this is the same thing that we just had on the Excel sheet. These payments increasing over time. What we're doing is borrowing and repaying. Let's go down here to the next page. We funded through year 20. And look at this. So if the product performs, my cash value continues to increase. And why that accumulation value looks so good there is that's not reflecting the loans in that column. So we can ignore that in this example. Look at your alternative scale or alternate scale. This assumes 3%, which we have yet to see an IUL that has lived the test of time, not an illustration based off of a well-designed policy, but one that has lived the test of time that has produced 3%. What happens? Quickly implodes. To prevent this, the policyholder would have to pay the loan interest on that large loan balance, or they would have to pump more money into the product. And if a policy lapses with a loan balance on it, well, I'd refer you to another video we did as far as tax implications on withdrawals and loans. Very important to understand that. But that is where people can get into trouble. So again, I do not want to just throw cold water on a strategy or such, but as we study actual performance, policies that have lived the test of time, strategies that are solid, okay, here's what I actually have, not an illustration. The illustration game happens so much in the insurance industry. We want to see real data. And again, we're doing what? We talk about this all the time. Maximizing policies for cash value and flexibility and working with corporations. We see them always design policies for maximum cash value and using those 4 major mutual companies very frequently. Whole life insurance products very frequently. Optimizing the cash value. Not because we're good at selling them on that. That's not the case at all, especially for me, because I'll talk myself out of a sale in a lot of times. It's more so, it's proof, data. Here's exactly how it works based off of a historical performance, not just projections. So know this was a lot of information. If you have any questions or would like to connect at any point in time, reach out. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.